Good evening. Welcome to the ShadowTrader Video Weekly for Sunday, March 6th, 2016. Let's start out with this crude chart here. There's been a very high correlation between the rise in crude oil and the rise in the S&P 500. I believe that that correlation has somewhat started to weaken. Certainly on Friday we saw the crude oil close up here at the high of the day, and the S&P backed off about 10 points from the high. We'll get into that in a second. But all that being said, I want to point out that there's a really strong trend line resistance coming up very, very shortly in crude. It's the dominant trend starting from mid-June here and coming down. Crude will open on Sunday night, just like the futures, so you can look to short there if there is that opportunity, if it does set up. But I would be watching very closely. I will be watching very closely on Sunday night to see what happens around this 3670 area in crude. And if it does weaken there, it'll be very interesting to see if the S&P futures do the same thing. So this is really important, especially given that this correlation has been high for a while here. So let's see what happens with crude coming into resistance. All right. As far as the S&P is concerned, I do feel that it's very overbought and could be coming back into range. There's a lot of factors here that point to the fact that we're probably going to have some sort of give back here. I don't think it's coincidence at all that Fibonacci from the all-time high here to the recent swing low, we just topped out on Friday. We're pretty much right there. The high in the S&P on Friday was 2009.13. And that fib is 2010. And I don't even know if that's exact. I could tighten it up a little bit. I didn't go exactly to the numbers. But it's basically close enough. Like, I think that basically Friday's action at the end of the day basically tagged the fib. So there's also the fact that we tend to look at how far a market gets overextended from the 20-period moving average, correct? And you can see here that this is 1919, let's call it. And the high went all the way to 2010. So this is like 80 points, right? This is 1920, 90 points actually, 90 points to the high from 1920 to 2010. That's a little bit extreme. If you recall, I've talked many times that I look for reversals to occur at about 60 to 70 points. As volatility increases, of course, that can get bigger. 90 is pretty extreme, so I wouldn't be surprised if there's a little bit of give back. So all that put together, especially if the crude gives some assistance, if the correlation continues and crude backs off Sunday night into Monday, and we see the S&Ps do the same, there'll probably be a little bit of give back this week. Now, all that being said, I wanted to point out that the sell-off on Friday, and it could have been because of the fib. If it's because of the fib, then it's a little bit more legit. But I do just want to also point out that when you see stuff like that happen at the end of the day, just remember that the longer-term money isn't waiting until the end of the day to sell it. They're going to be selling it early if they're going to be active. Now, it doesn't mean that it can't be the beginning of something because, as always, there's different levels to the buyers and sellers. There's different groups that they fit into according to their time frame. And we sometimes talk about a group called the innovators. Innovators are first. Innovators are the type that actually would be selling a high because of a fib. These are shorter-term traders. These would be people like myself who want to be right on the spot, who see directional trading is very precise, watching these levels, looking at market profile, turning points, Fibonacci retracements, trend lines, things like that. So could be. So we'll see. But when you sell off like that out of nowhere, I do also consider it somewhat of a liquidation break, and those breaks tend to strengthen the market, not weaken it, because it takes some of those late-to-the-party buyers out of there. So we'll see. I'm just trying to kind of always present both sides to it. One of the interesting things that Jim Dalton said very recently, I put it in my list of Daltonisms, I'm going to talk about that in a moment, is if you feel yourself stuck in cognitive dissonance, then argue the other side. And this is really important because I don't think there's any one problem that people can point to more than anything in terms of having losses in the market, sustaining losses. I think that the number one problem that people would be pointing to is that I came in with an idea and I couldn't see the other side. I didn't see it differently. So for instance, Good example would be I missed this rally because I couldn't see the other side. There were things there I wasn't thinking of, right? So argue the other side. It's very, very important. So, all right, that being said, I'm going to show you a couple things here in the profile that I think are interesting. Firstly, I do want to talk about this big rally, actually. I'm going to give you guys some spike rules that I think will help you out. I'll tell you exactly what was going on with me in this rally. But the first thing I want to do is just talk about looking at structure from this whole move up. I think it's still poor. I think that this is a house built on a shaky foundation. This is a very big up day. You have the two very big up days here where you had expansion of range, and both of them are multiple distribution days, right? You've got all these distributions inside with lots of single prints. That's not good. When you have expansion of range, you want the profile to look more like this. All right, you want it to look beefy in all parts, kind of, 5-6 TPOs wide. You want elongation, but not too stretched out and thin. So the stretched out and thinness is definitely indicative of forcing action, and you can think of forcing action as buying it because they have to, not because they want to. And as I've discussed recently, I think I talked about this on Tasty Trade. Remember, that doesn't just mean shorts. Remember that people who manage other people's money, they have to buy it, whether they want to or not. They may not like the location at all. They may have a bearish inclination, but they have to put the money to work or else the money is going away. They don't have any choice. There is no sit on the sidelines in that type of professional trading. You can just say, well, I don't like the market here, I'm not doing anything, etc. So that's one way actually where I think retail traders have a lot of advantage, because you don't have to constantly have this money at work. So what happens is you get these moves that are very, very much chasing, and because people's location is not optimal, it's often susceptible to breaks back in the other direction. That is what I believe the psychology is behind these stretched out moves. So definitely pointing that out. Also the fact that value here was overlapping, and then here you had a gap, which is a little bit more bullish in that it held up outside of it. But this move was just kind of struggling, overlapping value. And while it was struggling higher, I'm noticing on all of these days, or I shouldn't say on all of these days, but here on these 2 days specifically, that you had more of balance and you had point of control, especially here in the lower end of the range, right? And you closed up and away. And then here, obviously, we had, I wasn't surprised that value was actually here, only because it was the 2,000 level. So it made sense to me that on Friday there was going to be a lot of turnover of futures contracts back and forth around the 2,000, and hence that's why your point of control was there. All right. Spike rules. I want to point something out that has helped me immensely in this past week. This is here, Monday, Tuesday, Wednesday, actually for Friday. Okay, so here's Tuesday. Here's Monday's session here. And you had basically here on Monday's session, right, you had, and you guys are going to love this because it's really good. You had a huge sell-off down to the lows, but you had a sell-off inside of what's called a spike. And the next morning, Tuesday, we opened here. There's a little green dot there. You may not be able to see it, maybe too small. So I'm going to tell you what happened with me personally, and this will really drive the point home. Here, within this day, I initiated a put position. It's very convoluted. I'm not going to go into the details of it. But suffice it to say that by the end of the day, the way it was structured, I was quite nervous because the market had moved down pretty firmly and closed here at the lows, right? Closed here at the lows. And on Monday night, the market actually went a bit lower and then started to turn around and go back up, and went up quite a bit in that, notice that by Tuesday morning, it opened actually here, all the way up at 43. So I was able to reverse this position here for a small profit, a decent profit, but nothing like had I held it. And so I started thinking about this after. I was angry with myself, and then Jim Dalton came out with something the next day, because those of you that are doing the intensives, you know that he's doing his write-ups, and you have you're privy to those SPX write-ups if you register for the intensives. I'm going to talk about that in a bit. he said, you got to follow these spike rules in that if you think that this is a spike, and it is, which is very, very small amount of TPOs, single prints. I know this is like 3 wide here, but compared to this much value here, this is still a spike. So when you have a spike like that, if the market opens, I'm sorry, this keeps coming off on me there. If the market opens here above the spike, it's very, very bullish. What it's telling you is that these sellers have been cut off. That that these sellers are dead wrong, and they're actually, all these people inside this box, they're in big trouble. And I think the key signal here was that you went down into the spike and you didn't sell off further into the spike, and you went back to the open. And notice what happened. As soon as you went back to that open, it was huge. This was one of the largest SPX days in a very, very long time. I mean, the S&P's closed at 1978 after being as low down here as 1938. So you had a 40-handle run off the lows. And I talked about this in Tasty Trade, that I was very disappointed in myself for not just leaving that position alone, because I then did the math and I looked at how much it had made, and the profit would have literally been, by the end of the day, 5 times the amount. So this was somewhere where I was a little bit caught off guard. And the cognitive dissonance for me, where I was kind of having 2 competing ideas in my mind, was the fact that instead of focusing on this, the fact that they had gotten themselves oversold here, and then they were opening outside of that, which was very, very bullish. Instead of focusing on that, I was focusing on all of this before it, that I was thinking, oh, well, the market is just too overbought and it's in danger of coming lower, so I should probably close this, relatively close to the open. I think the market is, is susceptible to selling off. But you have to look at what's happening in the prior day as much more powerful and having more weight than that bigger picture behind it. Because in the short term, the market was clearly wanting much, much higher. And obviously that was 38 at the lows. The market went all the way to 2009 on Friday. So there's a huge, huge difference there. So that's something important to remember. These are called spike rules. When you see the spike like that, remember, assume that if they're selling it away from value and the close is down towards the low, they're definitely short in the hole. They have bad location. And then the next day's trade is going to confirm it. If you open up inside of the spike, well, it's still bearish. Not much has changed. But if the market opens up outside of the spike, okay, now these people are really in trouble, right? Think about it. It makes sense. If the open is in the spike down inside that whole area, well, there's no reason for these people that shorted in here to be really scared about anything. But of course, up in here, it's a whole different story. All right. So that's profile for now. Okay, so that whole thing I just talked about on the spike rules and everything. If you're interested in learning about those types of nuances, again, it's shadowtrader.net/Dalton, D-A-L-T-O-N, and this has been updated now finally. So this is the last intensive that Dalton's going to be teaching, April 4th. I highly recommend it. And I have something special for you if you sign up. Very excited about this. On Monday after the close, I am going to be recording an exclusive video with Jim Dalton. It's probably going to be at least an hour long, if not more. And I'm going to be talking about some of the nuances in the profile that I learned from his live seminars. I met him twice in Chicago, and I attended 2 seminars of his. They were about 4 days long. Mind-blowingly good. Unfortunately, he doesn't do those anymore. Now he's just doing the intensives, which are pretty awesome regardless. I mean, the intensives are longer. The intensives are like 3 to 4 weeks, and you get the reports every day, and he's doing live analysis in the markets each morning. But regardless, the video that we're going to record, we're going to be talking about a lot of the nuances that I learned at his seminars, a lot of the notes that I've taken from him, personal conversations that I've had with him over the phone. I've taken notes on that as well. I'm going to be discussing these things with him in like a GoToMeeting Skype type call with webcams. It's going to be cool. And this video is going to be exclusive only to people who sign up for the April 4th intensive or buy a DVD set or digital download of Field of Vision or whatever through shadowtrader.net through this link. If you have purchased something before for the first intensive, I will not leave you out to dry. I will set something up with him to make sure that you guys get it. I'll speak to Julia over there, and we'll see if we can. I'll see if I can, make sure that you guys get a copy of the video. But anyway, it's going to be exclusive, and like I said, if you buy something here through the link shadowtrader.net/Dalton to sign up for the last intensive, you will receive that. I cannot stress enough. I know I've been kind of harping on this, but how amazingly valuable this knowledge is. I think if you go back or you just recall what I just talked about the mistake I made on Tuesday and the thought process that I'm doing and the work I'm doing to rectify that and make sure that it doesn't happen again so that I can be part of that bigger move, etc., it all comes from this. So if you really have deep interest in getting better at the game, continuing to hone your skills, this is where you need to be. I'm telling you, this will pay you back in spades. I can't recommend this enough. So anyway, last chance. He's retiring. This is the last intensive he's ever going to teach. If it's too daunting for you, you think you're too much of a beginner, or you can't do the time commitment, then I highly recommend, at the very least, getting the Field of Vision. I started with those. I watched the DVD set like 3 or 4 times before I ever went to visit him and took notes on it, and I thought it was incredible. So anyway, I'll be coming out also with a mass email to everybody who's on our email list, with these links and whatever. So that's that. All right. On behalf of myself and the entire Shadow Trader team here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.